Picture this. It's the late 1980s, and Japan looks unstoppable. The country's economy has been booming for decades. Its companies are conquering the world, and Tokyo's property prices have gone completely mad. People used to joke that the Imperial Palace in Tokyo was worth more than all the real estate in California. Crazy, right? But that's how inflated everything had become. Japan wasn't just winning the race. It seemed like it had invented a new kind of capitalism. Everybody wanted to be Japan, until it all fell apart. So what went wrong? Well, here's where it gets interesting. During the 80s, Japan's banks were lending money like it was going out of style. Interest rates were low, optimism was high, and speculation became a national sport. People weren't buying property because they needed a home. They were buying because they believed the price would always rise. That, right there, is what we call a speculative bubble, when prices stop reflecting reality and start reflecting pure hype. And like every bubble in history, this one had to pop. Now imagine you're a banker in Tokyo back then. You open your balance sheet and it's full of loans backed by real estate. The land value just keeps rising, so you feel untouchable. You lend more, you expand your portfolio, and your clients keep coming back for more. It's a feedback loop of greed and confidence, and it feeds on itself. But when prices finally stop climbing, when that unstoppable rise slows down just a little, suddenly the math doesn't add up anymore. That's when fear enters the room. In the year 1990, the miracle ended. The Nikkei stock index, which had soared past 38,000 points, started to collapse. Property prices followed. Land that was once considered can't miss suddenly lost half its value. The government tried to downplay it, saying it was just a correction, but insiders knew the truth. This was a full-blown implosion. Millions saw their life savings evaporate overnight. Banks that had looked like titans turned out to be empty shells. And the country that had been the model of modern capitalism, now it was in panic mode. Here's the thing. Asset bubbles aren't just about money. They're about psychology. When you've spent 10 years believing your wealth will always grow, you build your life around that idea. You borrow more, you plan big, you take risks. So when the bubble bursts, it's not just numbers that fall, it's confidence, ambition, and national pride. Japan's government called it an adjustment period. Economists later called it the beginning of the lost decade. Spoiler alert, it lasted nearly 2. Now you might be thinking, how could a government full of brilliant technocrats not see it coming? Well, that's part of the tragedy. Policymakers did see the bubble, but they were afraid of pricking it. You know, kind of like how no one wants to be the guy who ends the party by turning on the lights. The Bank of Japan eventually raised interest rates to cool things down, but by then, the bubble had grown monstrous. Once the air started coming out, there was no stopping it. Let's talk numbers for a second, or rather, let's talk what they meant emotionally. Between 1986 and 1991, the total value of land in Japan tripled. Then, within a few years, it lost more than half. Imagine buying a house at the peak, only to learn that the market value had fallen by 60% before you even finished furnishing it. It wasn't just a market problem, it became a social trauma. Banks were suddenly holding assets that weren't worth the paper their contracts were written on. And when your entire financial system is built on collateral, that's catastrophic. Here's where the story takes a dark twist. Instead of allowing the weak banks to fail, the government decided to protect them, to keep them alive, at least in name. Imagine a hospital full of patients who are clinically dead, but the doctors keep hooking them up to machines. That's what started happening in Japan's financial sector. They were called zombie banks. You see where we're going with this. But before we dive deeper into that, let's understand why the bubble had to burst in such a violent way. At the core of any bubble is cheap credit. The Bank of Japan had kept interest rates extremely low throughout the 80s to stimulate growth. Money flowed freely, and companies borrowed with both hands. The problem: when credit is cheap, people start taking on debt they shouldn't. It's like giving everyone in a casino a loan. Sooner or later, someone is going to overplay their hand. And when everyone overplays at once, you've got a systemic problem. So when the rates finally went up, even slightly, the house of cards collapsed. There's a powerful irony here. Japan's economic model was, in theory, built on prudence. The culture valued stability, loyalty, and long-term vision. But during those years, it all got swept up in the madness of easy credit. You'd see farmers selling land for millions, companies speculating in property instead of investing in innovation, even banks turning into casinos. Everyone thought they were safe because everyone else was doing the same thing. Sound familiar? It should. That's basically what happened again in 2008 with the subprime crisis in the United States. Different time, same script. When the crash hit, Japan's government faced a nightmare. They couldn't let the banks fail because that would destroy public confidence and wipe out savings. But saving them also meant pretending that the bad loans were somehow still good. So they started a game of make-believe. Banks kept lending to insolvent companies just to avoid admitting losses, and the government kept injecting money into the system, hoping time would fix everything. Spoiler: time didn't fix anything. It just turned the crisis into a slow-motion disaster. The effect on regular people was chilling. If you lived through it, you'd remember how quiet the streets got. Businesses stopped expanding. Young people delayed starting families. The sense of opportunity, that optimism that had defined the 80s, vanished. Japan still looked rich. The trains still ran on time. The cities still glowed at night. But under the surface, the heartbeat of growth had stopped. It was prosperity on life support. You might wonder, why didn't other countries learn from this earlier? Part of the reason is that Japan's crisis was uniquely complex. Its government, its corporations, and its banks were all deeply intertwined. Big banks financed big manufacturers, and politicians protected both. It wasn't a free market correction, it was a systemic freeze. So instead of quick pain and recovery, Japan chose slow pain and paralysis. And that choice defined an entire generation. It's important to understand that the bursting of this bubble didn't just destroy wealth, it reshaped the Japanese psyche. People who came of age in those years learned to fear debt and avoid risk. For decades afterward, Japan's households hoarded savings instead of investing. Corporations sat on mountains of cash rather than innovate or expand. The culture of overconfidence flipped into one of overcaution. The energy of growth turned into the inertia of survival. And yet, despite all this, the country didn't collapse. That's the strange beauty of Japan. It didn't riot, it didn't crumble into political chaos. It endured. But endurance came at a cost. 20 years of stagnation, called the lost decades. And at the center of that long winter was a decision made in the early 90s. To keep the system alive at all costs. That's how we ended up with zombie banks. Imagine institutions that should have died, but instead sucked resources from the living. The idea sounds straight out of a horror movie, but it's deadly real in economics. Before we move on, take a second to think about this paradox. Japan, the most futuristic nation on Earth, was haunted by the economic undead. Banks that couldn't lend, companies that couldn't grow, people who couldn't dream, all because, when the bubble burst, no one had the courage to clean up the mess properly. So when they talk about Japan's bubble economy, remember, it wasn't just about numbers. It was about fear, denial, and the high price of pretending everything's fine. In the next part, we're going to dig into what these so-called zombie banks really were, how they functioned, why they survived, and how they managed to drag an entire economy into 2 lost decades. But for now, keep this in mind. The day Japan's bubble burst wasn't just the end of an era. It was the beginning of one of the strangest economic experiments in modern history, an experiment that still echoes every time a government refuses to let something fail. All right, so Japan's bubble had burst, leaving behind chaos, fear, and broken dreams. But what really came crawling out of the ruins were not ghosts. They were something way scarier for an economy: zombie banks. And no, we're not talking about monsters from a movie. A zombie bank is a financial institution that looks alive from the outside. Lights on, employees working, branches open. But inside, it's completely dead. It only survives because the government keeps pumping money and support into it, even though everyone knows it's technically insolvent. Let's break that down. A bank becomes insolvent when the loans it has made, the assets it owns, lose so much value that the bank can't cover its own debts. Imagine you lend money to 10 friends, expecting to be paid back with interest, but suddenly 8 of them lose their jobs and can't repay you. On paper, you still look like you have assets, right? But in reality, those IOUs are worthless. That was Japan's situation in the early 90s. The banks had lent to property developers, corporations, and even average citizens, betting that prices would rise forever. They didn't. So when the bubble burst, the whole banking system started rotting from the inside. Now, here's where it gets absurd. Instead of letting those dead banks fail, Japan's government decided to prop them up. They lowered interest rates to nearly zero, offered emergency loans, and pretended that the bad debts weren't really that bad. It was like keeping a corpse in your living room because you can't bring yourself to bury it. The logic was simple. If the banks died, so would the economy. The trouble was, as long as the banks refused to acknowledge their losses, no one could move forward. Everyone was stuck in economic purgatory. Why would a government make such a decision, though? Well, politics plays its part. Big Japanese banks weren't just private companies. They were deeply tied to the political establishment and to big corporations through something called keiretsu, those tight business networks where banks, manufacturers, and investors all held pieces of each other. If one of the big banks went down, it didn't just hurt shareholders. It threatened the entire industrial ecosystem. Think car makers, rail companies, and tech giants all depending on the same lenders. That was the nightmare the government wanted to avoid. So what did they do? They started pretending everything was fine. Banks rolled over bad loans, basically lending more money to companies just so those companies could pay back old debts. It's like giving someone another credit card to cover the first one. On paper, the books looked tidy. In reality, the hole got deeper and deeper. These evergreen loans turned the banks into walking dead institutions, unable to lend to new businesses or support real innovation. Japan's credit arteries were clogged with bad debt, and no new blood could flow. Now, here's the fun part. While these zombie banks were technically alive, they were doing the opposite of what a bank should do. Normally, a bank takes savings from depositors and channels them into productive investments, like helping a new company expand or giving a young couple a mortgage. But zombie banks can't do that. They're too busy hiding their own failures, keeping unhealthy relationships with failing companies, and praying that the government doesn't pull the plug. They're like hospitals that refuse to discharge patients, trapping resources inside instead of letting the system breathe. This is where the term zombie fits perfectly. These banks feed off public money, and in return, they infect the economy with stagnation. Companies that should have disappeared, the so-called zombie firms, survive because their zombie banks keep them afloat. Everyone keeps going through the motions, paying salaries, pretending to grow, pretending to innovate, but nothing truly moves. Productivity slows, wages freeze, and the entire economy turns gray and lifeless. Sounds familiar? Many economists still argue that the same syndrome appeared in parts of Europe after the 2008 financial crisis. Let's pause and define a couple of things in plain English. When a bank's capital is wiped out, but it doesn't go bankrupt, it becomes what economists call economically insolvent but politically protected. In short, it's too weak to function normally, but too connected to fail. And when these banks dominate the system, the whole country ends up supporting them whether it wants to or not. Because if you're a saver or a taxpayer, you're part of the life support system, even if you didn't sign up for it. Now you might be thinking, why didn't anyone just clean house? Wouldn't it have been better to let the bad banks fall early and start fresh? That's the rational thing, sure. But imagine telling millions of people that their savings are gone, their credit is frozen, and their employers might not get financing next month. That's the kind of political suicide few governments are willing to face. So instead, Japan chose the slow path, patching holes, printing money, and praying that growth would one day return. Spoiler alert, it didn't, at least not for a long while. Let's get personal for a moment. If you had been an entrepreneur in Japan in the 90s, trying to start a new business, you'd have run into a wall. Banks just weren't lending to newcomers. They preferred to keep funding old partners, even if those partners were failing. It's what economists later called the credit misallocation trap. New ideas starved while old dinosaurs kept eating. And that's one reason why innovation in Japan slowed dramatically after the bubble. The same country that gave the world the Walkman and the bullet train sort of lost its creative spark. There's another side to this story: interest rates. The Bank of Japan lowered them so much that saving became pointless. If you left your money in the bank, it earned almost nothing. But investing felt dangerous because everything had just collapsed. So people did what humans always do in times of uncertainty. They froze. They hoarded cash, waited, and hoped. The result was a vicious cycle. Low demand led to low profits, which led to lower wages, which led to even lower demand. It's the economic version of a slow heartbeat. Now here comes the tricky part. A zombie bank isn't always obvious from the outside. They still have offices, they still release reports, and their logos still look shiny. But if you dig into their balance sheets, you'll see a graveyard of bad loans. The difference between a healthy and a zombie bank lies in the ability to take losses honestly. Healthy banks bite the bullet, write down the bad loans, recapitalize, and move on. Zombies pretend everything's fine. And when you've got an entire banking system doing that, you end up with what economists call a balance sheet recession. Basically, a period when everyone is trying to repair their finances instead of spending or investing. Think about that term for a second. Balance sheet recession. It sounds technical, but it just means everyone is acting scared. Households save, companies pay down debt, and banks stop lending. The government steps in with stimulus packages, but they barely move the needle because the mindset has changed. People are no longer chasing profit, they're chasing safety. That's how the economy becomes zombified, not through a sudden crash, but through prolonged paralysis. There's something deeply psychological about this too. A zombie bank reflects society's inability to accept loss. Instead of admitting mistakes and rebuilding, the system chooses denial. It's the classic kick the can down the road approach. Fix it later, maybe never. The price of that denial, though, is stagnation. It's like keeping an infected wound covered so no one sees it, but then letting the infection spread to the rest of the body. And it spreads in more ways than you might imagine. Because when zombie banks control the flow of credit, they shape the entire economy's direction. Young businesses with potential can't grow because the funding never reaches them. Meanwhile, giant but unprofitable corporations keep getting loans just to survive. It's capitalism turned upside down, survival of the least fit. And once that becomes normal, innovation suffocates. The future starts looking like the past, only duller. What's fascinating is that Japan's zombie phenomenon didn't just affect banks and corporations. It changed the behavior of its people too. Consumers stopped trusting the system. Borrowing became taboo. Risk became a dirty word. A whole generation grew up seeing loans as traps instead of opportunities. Even decades later, Japanese households remain among the most cautious in the world. The trauma left by zombie banks outlived the banks themselves. Now imagine this scene. Across Tokyo, Osaka, and Nagoya, sleek bank towers glittered under neon lights, but inside those towers, executives were balancing books filled with ghosts. Loans that would never be paid back. Investments that would never yield returns. Yet, year after year, they reported modest profits thanks to accounting tricks, government subsidies, and regulatory forbearance. That's a fancy term for looking the other way. The illusion of stability became more important than the reality of recovery. You could say that Japan's zombie banks turned the whole country into an economic where time stood still. Growth never truly died, but it never truly lived either. GDP leveled out. Inflation turned negative, and even the central bank seemed trapped in an endless cycle of printing money just to keep the body warm. Japan didn't collapse into crisis. It drifted into limbo. And limbo, unlike crisis, doesn't scare people enough to change. It just makes them numb. Eventually, the rest of the world started using the term zombie bank to describe similar phenomena elsewhere. In the 2008 crash, for example, many Western governments faced the same dilemma. Do you let your biggest banks fail and risk chaos? Or do you keep them alive and risk stagnation? Guess which option they picked? The lesson from Japan wasn't really learned. It was repeated, because even when we know better, fear often beats logic. So when you hear the phrase zombie bank, don't picture a monster eating brains in a horror movie. Picture a banker sipping coffee in a glass office, smiling for the camera, while the balance sheet in front of him quietly decomposes. Picture a government pretending the system is fine because admitting otherwise would cause panic. Picture an entire economy walking, breathing, and functioning, but without a pulse. That's the real horror story. In the next chapter, we'll look at how Japan tried to fix this mess, or rather, how its attempted cure ended up making the disease even worse. Because sometimes, when you try to save something that's already dead, you end up dragging yourself down with it. So now that we've met the zombies, let's talk about the doctors who tried to cure them, and how their medicine made everything worse. After Japan's bubble burst, the government and the Bank of Japan faced a terrifying collapse in confidence. People were scared, markets were falling, and politicians felt cornered. They needed action fast, so they threw everything they could at the problem, cutting interest rates, pumping cash into the system, and bailing out the sickest banks. But instead of healing the patient, the treatment just prolonged the pain. Let's rewind to the early 1990s. The economy had just crashed, and policymakers were desperate to stop the bleeding. Their first move was to lower interest rates, hoping cheap money would spark new borrowing and investment. Makes sense, right? When money costs less, people should borrow more and spend more. But here's the catch. In Japan, no one wanted to borrow anything anymore. Corporations were already drowning in debt, and consumers had just seen their wealth disappear in the biggest asset collapse in modern history. You can offer free loans to a traumatized population, but if trust is gone, credit doesn't move. To make things worse, the Bank of Japan cut rates too late. By the time they acted, the deflationary spiral, when prices fall and people expect them to keep falling, had already started. Imagine waiting months to buy a new car because you know it'll be cheaper next year. When millions of people think like that, the entire economy freezes. Businesses can't raise prices, profits vanish, and wages drop. That's how deflation turns into a vicious cycle, and Japan got stuck in that loop for almost 2 decades. Meanwhile, the banks were rotting from within. Remember all those bad loans from the bubble years? They were still sitting on balance sheets, hidden like skeletons in a closet. Instead of forcing banks to face reality and let weak ones fail, the government chose to buy time. They gave public guarantees on deposits, loaned directly to the broken banks, and even organized mergers between the weak and the weaker. It's like treating a patient's fever by moving it to a bigger room. Comforting maybe, but not a cure. Here's where the real paradox kicks in. Those policies were supposed to restore confidence, but what they actually did was destroy discipline. The more help the banks received, the less incentive they had to change. Think about it. Why clean up your mess if the government will keep bailing you out? Economists call this moral hazard, when safety nets make people reckless. It was this moral hazard, more than the crash itself, that kept Japan frozen in its lost decade. At the same time, the government went all in on public spending. Highways, bridges, monuments, you name it, they built it. Japan's budget deficits exploded, and its national debt started climbing toward absurd levels. Now, infrastructure isn't bad by itself, but much of what they built made little sense economically. Towns ended up with brand new airports that no one used, fishing villages with luxury roads, and concrete covering entire coastlines. It was Keynesian economics on steroids, except the patient was too weak to digest the medicine. The idea was to stimulate growth by creating jobs and demand. But since the private sector was saving instead of spending, most of that stimulus went into unproductive projects. And because the government had to borrow massively to pay for it, the long-term burden only grew heavier. By the end of the millennium, Japan's public debt had reached levels nobody thought possible for a developed country. The country wasn't collapsing, but it wasn't recovering either. It was like an engine idling endlessly, but never shifting into gear. Now let's talk about the central bank's most controversial move, quantitative easing, before it even had that name. The Bank of Japan started buying financial assets and government bonds, injecting liquidity directly into the system. The idea was to flood the economy with money and encourage lending. But once again, the banks didn't lend. They just used that money to patch their balance sheets and survive another quarter. The liquidity got trapped inside the financial system instead of reaching real businesses. A river of money, but no current. The irony is painful. Every policy that was meant to spark life ended up preserving the undead. Every time the government intervened, it removed pressure for reform. Every time it saved a bank, it stopped new ones from emerging. Japan was treating symptoms, not causes, and that's why the lost decade turned into lost decades, plural. You can't recover productivity when your capital is tied up in deadweight institutions. This is where the story turns psychological again. Crisis management in Japan wasn't just about numbers. It was about shame, hierarchy, and denial. Failing publicly was considered dishonorable, both for companies and bureaucrats, so the entire establishment conspired, quietly and politely, to hide the problem rather than confront it. Executives refused to admit insolvency. Government officials delayed audits. Even investors pretended things were fine because everyone feared the alternative would be chaos. Denial became national policy. Compare that to what happened in other countries later. When the United States faced its own financial meltdown in 2008, it also bailed out some banks. But it forced others to merge or restructure, and it recapitalized the system fast. Harsh, yes, but decisive. Japan couldn't bring itself to swing that axe. Its system valued harmony over confrontation, and that cultural instinct, while noble, became an economic trap. Japan avoided a crash on the surface, but paid for it with 20 years of stagnation. Here's an analogy you'll like. Imagine your house catches fire. The Japanese approach was to close all the doors, seal the windows, and try to smother the flames slowly, hoping they'd go out on their own. The flames didn't spread, sure, but they kept burning under the floorboards for decades. Occasionally, someone would open a new door, a new stimulus, a new bailout, and the smoke would rise again. Meanwhile, the house stayed unlivable. That's what Japan's recovery really looked like. Let's not forget the human side of those economic charts. People suffered in silence. Young workers faced hiring freezes. Graduate students could no longer count on corporate careers. Small businesses closed, and those who survived clung to life through credit extensions and government contracts. The average salary stagnated for nearly 2 decades, even as the cost of living, though not officially rising, continued to squeeze families. The dream of the 80s, of owning a home and climbing the corporate ladder, slowly turned into a national daydream that no one really believed in anymore. And here's the crazy thing: inflation, the big economic villain in most countries, was completely absent. Prices kept going down or stayed flat. On paper, that sounds great. Stable prices, no inflation, right? But deflation is a silent killer. It rewards saving over spending, punishes risk-taking, and saps the energy out of an economy. When prices and wages stop moving, ambition freezes with them. Why bother trying harder, people think, if everything stays the same? That's how you get a society that works, but doesn't grow. Now let's go back to the government side. By the late 90s, even politicians realized something had gone terribly wrong. A few brave officials started calling out the zombification of the banking system. They pushed for restructuring and cleanup, but it was already too late. The problem had metastasized. Cleaning it up meant forcing bankruptcies, laying off workers, and shaking the entire economic hierarchy. Risky business in a country obsessed with social stability. So once again, they settled for half measures. Cosmetic reforms, new roundtables, and another batch of reconstruction funds. In short, more of the same. Sometimes the attempt to avoid short-term pain only guarantees long-term decay. Japan became a living case study of that rule. Other countries, especially in Europe, later fell into the same trap. "We'll fix it quietly," they said, slowly, without panic. But slow fixes don't heal deep wounds. They scar over, trapping the infection inside. In Japan's case, that infection was debt, denial, and the refusal to let markets do their brutal but necessary cleansing. By the turn of the century, Japan's recovery campaigns had become a ritual. Each year brought a new stimulus plan, a new financial package, a new government promise to push inflation back to 2%. But the pattern always repeated: a brief flicker of activity, followed by relapse into stagnation. The zombies wouldn't die, and the doctors had no new medicine. The younger generation began to accept low growth as normal, even desirable, because chaos seemed worse. Economic pain became cultural stoicism. What makes this story even more haunting is that Japan avoided what economists call a hard landing. There were no riots, no bank runs, no currency collapse. The streets stayed orderly, the trains punctual. On the surface, life looked comfortable. That illusion of calm became Japan's greatest trap. Because when a society gets used to stagnation without suffering enough to rebel, it loses the pressure to change. The fire keeps burning, silently. Still, not everything was doom and gloom. By the early 2000s, Japan had begun forcing some restructuring and recapitalization under new laws. Several zombie banks finally merged into megabanks that cleaned up their books. It was progress, but it came a decade too late. The damage to trust, innovation, and demographic vitality had already been done. The lost decade had become part of Japan's identity. People joked that depression was just the new normal, but beneath the jokes, there was quiet sadness. So when economists say, the cure became the disease, this is what they mean. Every emergency measure, zero interest rates, bailouts, public works, quantitative easing, was a rational reaction to crisis. But together, they built a system addicted to easy money and terrified of change. Instead of letting the patient recover naturally through pain and restructuring, Japan kept it sedated. comfortable but comatose. And that's why economists worldwide still study Japan's lost decades like doctors studying a patient that survived but never woke up. In the next chapter, we'll look beyond the numbers and see what living in that kind of economy actually feels like. Because when the entire country becomes a half-speed machine for 20 years, it doesn't just affect balance sheets. It changes people's minds, families, and dreams. And that, more than any statistic, is what makes Japan's story both tragic and fascinating. Imagine waking up every day for 20 years in a country where everything works perfectly. The trains are on time, the cities are safe, the technology is world-class, but deep down, nothing truly changes. That was Japan during its so-called lost decades. It wasn't a collapse, and it wasn't a recovery. It was something stranger, a limbo, a quiet kind of economic undead state where people kept moving, working, consuming, but with no real spark. You could say Japan became the world's most functional zombie, alive enough to survive, too dead to grow. After the crisis of the early 90s, the Japanese people had to adapt to a new normal. Growth, once assumed to be eternal, disappeared. The average worker who had seen their salary rise year after year now faced flat paychecks, shrinking bonuses, and less job security. Students who had once dreamed of joining major corporations got stuck in part-time or contract work. They called them the lost generation, young people who came of age in an economy that had forgotten how to dream big. Now, let's talk about what it actually felt like. Deflation, falling prices, might sound like a good thing if you're used to inflation eating away your savings. But when prices keep dropping, so do profits, and therefore wages. Businesses stop investing because the future looks cheaper and bleaker. People stop spending, afraid that money today will be worth more tomorrow. It's the opposite of growth psychology, and Japan lived in it for years. Every purchase became a calculation. Every investment a risk no one wanted to take. So how did daily life look for the average person? Stable, almost too stable. Jobs didn't disappear overnight, but career paths did. Promotions slowed down. Corporate hierarchies froze. And entrepreneurship virtually vanished. A culture built on stability became one addicted to safety. Middle-class families focused on saving, not living. The idea of taking risks, starting a business, investing abroad, even changing jobs, became unthinkable. Japan, the country that once defined economic ambition, settled into a long, polite stagnation. It's not that there were no rich people or successful companies. Of course there were. Tech giants still thrived, and export industries kept Japan on the global map. But innovation lost its edge. The hunger that had driven the 80s to outcompete, outbuild, and outsmart the world faded into resignation. Engineers who once changed industries now worked to maintain existing products. Engineers ran headfirst into bureaucracy and tight credit conditions. And bankers? They were too busy keeping zombie clients alive to fund fresh ideas. Here comes the irony. Japan's greatest strength, its social cohesion, became its weakness. During these decades, there were no protests, no social unrest, no populist revolts. People endured. They saved. They adapted. They kept the system running. On the surface, it looked admirable, but that collective endurance masked something deeper, a fear of change so strong that the entire society built a culture around avoiding risk. The same patience and harmony that once built economic miracles now sustained the status quo. Meanwhile, the government kept fueling the illusion of stability. Public debt ballooned as stimulus followed stimulus. New construction projects popped up everywhere. Bridges to nowhere, tunnels through mountains, shiny train stations that saw little traffic. Politicians justified it as job creation, but everyone knew it was just another way to keep money flowing into the system. These spending sprees gave short-term relief, but no long-term renewal. The body stayed alive, yes, but only by injecting more and more financial morphine. For ordinary citizens, the emotional toll was subtle but real. Imagine growing up, hearing your parents talk about how rich and unstoppable Japan used to be, while your own reality is marked by low raises and uncertain futures. It's a collective identity crisis. People started defining success differently, not by growth or wealth, but by stability and endurance. The dream wasn't to get ahead, but to not fall behind. When ambition becomes something dangerous, you know something in the social DNA has changed. The housing market is a perfect example. In most countries, property is seen as a path to wealth. In Japan, after the crash, it became a warning sign. Families who bought homes during the bubble spent decades paying mortgages on assets that kept losing value. It created what economists called negative equity, meaning your house was worth less than your debt. Imagine how that changes your psychology. You stop thinking like an investor and start thinking like a survivor. That mindset shaped an entire generation. Remember the banks we talked about? Those zombie banks didn't just distort finance, they distorted life. By refusing to die, they prevented new institutions from emerging. Young entrepreneurs couldn't secure loans because old companies, the living dead of the corporate world, soaked up all the credit. Failed firms limped on, paying minimal wages and offering minimal innovation. It was as if time itself had slowed down. The result? Productivity stagnated, and the country's once unstoppable engine of progress sputtered quietly. Even demographics joined the crisis. Japan's population began aging rapidly as fewer young people married or had kids. Why bring a child into an economy where you can't promise them a better future? When people lose economic optimism, birth rates fall. It's that simple. By the 2000s, Japan's demographic pyramid looked inverted. More retirees than workers. The so-called silver economy became another zombie sector, kept alive by massive state spending on pensions and healthcare, but unable to renew itself organically. Now, a lot of what happened in Japan challenges classic economic theory. Normally, after a crash, bad companies die, good ones adapt, and growth eventually resumes. But in Japan's undead economy, failure wasn't allowed. No one wanted to take responsibility for pain. The result was a society frozen between recession and recovery, trapped in a middle ground economists call secular stagnation. It's like living in an eternal Monday. The week never really begins, and it never truly ends. Still, the Japanese people continued to work hard, maybe even harder than before. Office lights burned late into the night, trains overflowed during rush hour, and production lines never stopped. Yet all that effort didn't translate into greater prosperity. Wages lagged, consumption stagnated, and even corporate profits, when they appeared, often went into cash reserves instead of fresh investment. It was as if the entire economy was running on a treadmill. A lot of motion, no real movement. One thing that stood out during this era was the emotional fatigue. Self-help books about finding meaning replaced books about making money. Workplaces began to prioritize overwork and dedication over creativity. There were even reports of young employees developing depression and burnout, phenomena that came to be labeled under the word karoshi, or death from overwork. Imagine that, a country so disciplined that people literally worked themselves to death in an economy going nowhere. That's the dark poetry of Japan's lost decades. The younger generation responded in its own way. Many rejected traditional corporate life entirely. They became freelancers, part-time workers, or digital nomads before the term even existed. They were called freeders, from the English free. But the irony was that their freedom wasn't chosen. It was forced. No stable jobs, no pensions, and often no long-term hopes. Yet among them also emerged new forms of resilience, creativity, minimalism, and the first sparks of what would later become Japan's rise as a leader in cultural exports, from anime to gaming. Even in stagnation, a kind of quiet innovation survived. And let's not forget the emotional contract between citizens and the state. For decades, Japan's unwritten promise had been simple: You work hard and the system takes care of you. That promise broke during the lost decades. The government did step in to stabilize things, yes, but the sense of security never fully returned. People trusted the system less, not more. They saw what happened to their parents' savings, to the so-called safe assets that turned toxic overnight. Trust once cracked never returned to its old shape. If you compare Japan's situation to other crises, it's almost philosophical. In many Western countries, economic pain explodes quickly. Protests, layoffs, bankruptcies. Then recovery comes faster. In Japan, the pain diffused slowly like fog, touching everything but never strong enough to break anything completely. That diffuse suffering left no single villain to blame, and no single policy that could fix it. It became a kind of collective exhaustion, so deep that it redefined the meaning of success and failure. But despite everything, or maybe because of it, Japan endured. It didn't default on its debt. It didn't spiral into hyperinflation. Its society stayed intact, respectful, coherent. The trains still ran. Kids still went to school. Innovation didn't disappear completely. It's as if Japan found a way to live comfortably with its own economic ghosts. That's perhaps the most fascinating part. How a nation can sustain decades of near-zero growth and still remain one of the wealthiest, safest, and most technologically advanced societies on Earth. Of course, endurance has a price. You can't sustain an undead economy forever without consequences. Japan's debt kept growing. Its workforce kept shrinking. Its youth continued to search for meaning beyond money. By the time other countries faced their own crises, like the global crash of 2008, Japan had already become the warning nobody wanted to hear. The world saw its stagnation not as failure, but as something that only Japan could experience. History later proved otherwise. In many ways, living inside that undead economy became Japan's superpower. The country learned how to function in low growth like others learned to function under inflation. It built efficiency, discipline, and resilience that still define it today. But that resilience came from necessity, not design. People made peace with slow change, but they also lost something intangible, the belief that tomorrow would always be better than today. And that's the saddest outcome of all. So when you walk through Tokyo and see the glow of vending machines, the perfectly clean streets, the quiet pride of its citizens, remember this: beneath that calm surface lies a story of endurance, compromise, and invisible pain. Japan didn't collapse. It adapted. It learned to live with its undead economy, to coexist with stagnation as if it were normal. In the next chapter, we'll see how this phenomenon didn't stop at Japan's shores. Because as it turns out, the zombies learned to travel, and soon the rest of the world started catching the same disease. By the time Japan entered the 2000s, the rest of the world was looking at its long stagnation with a mix of pity and smugness. Politicians and economists in other countries would say, "That could never happen here." They saw Japan's situation as a cultural oddity, a side effect of its unique banking system and its national obsession with stability. But history, as it loves to do, had a dark joke prepared. Because only a few years later, the same disease that began in Japan would infect the entire global economy. And this time, the zombies didn't speak Japanese. Let's fast forward to the early 2000s. The world, and especially the country of the Uncle Sam, was riding another wave of euphoria. Real estate prices were soaring, credit was cheap, and banks were minting profits faster than ever before. Every family thought it was clever to buy new houses, refinance old ones, or stack up loans for investment. That kind of self-reinforcing optimism may sound familiar. It was the same fuel that powered Japan's bubble back in the 80s. The names had changed, but the tune was identical: easy money, speculative borrowing, and faith that the good times would never end. When that global bubble finally burst in 2008, The parallels to Japan became impossible to ignore. Big Western banks suddenly found themselves holding mountains of toxic assets, loans that looked profitable on paper, but were worth almost nothing in the real world. People panicked, markets crashed, and governments were again forced to step in. What did they do? They bailed out the banks, cut interest rates to near zero, and printed massive amounts of money. Sound familiar? It should, because Japan had already done that playbook 20 years earlier. In fact, economists around the world used to call Japan's response a cautionary tale. But in 2008, that same approach became global policy. The disease Japan had tried to contain, the refusal to let financial institutions fail, had finally gone international. The zombie infection had crossed the Pacific. Central banks from Washington to London to Frankfurt suddenly became the life support machines for giant financial bodies that should have collapsed naturally. The world had officially entered the age of the undead economy. Now, let's unpack how the contagion spreads. A zombie bank doesn't just stay dead on its own. It needs a host, a government that refuses to pull the plug. And in a world built on interconnected finance, once you subsidize one dying bank, you're forced to support the others to prevent chain reactions. So every bailout creates more moral hazard. Every safety net becomes a web. And before you know it, the system's too entangled to reform. Everyone's afraid to let anything fall because everything's connected to everything else. It's capitalism without consequences, a truly global version of Japan's slow paralysis. Here's a question for you. What's worse? A crisis that ends violently, or one that never ends at all? Japan showed that slow decline can be as destructive as sudden collapse, just more invisible. And now imagine that slow-motion decay on a worldwide scale. After 2008, interest rates stayed near zero across advanced economies for a decade. Companies that should have gone bankrupt kept refinancing their debt. Governments borrowed like there was no tomorrow. It wasn't growth. It was survival dressed as success. You could almost hear Japan whispering, "Welcome to my world." Developed economies began to replicate Japan's symptoms one by one. Productivity slowed. Inflation disappeared. Corporate profits rose, but wages didn't. And banks, sitting on piles of questionable assets, continued to receive endless support from central banks. The line between private risk and public responsibility completely blurred. When profit was private, but loss became public debt, the moral fabric of capitalism started unraveling. Every system that rewards failure instead of punishing it creates zombies. It's economic evolution in reverse. The Eurozone crisis a few years later was a masterclass in zombification. Countries like Italy, Spain, and Greece found themselves loaded with debt, unable to grow, yet still kept alive through a mix of emergency loans and creative accounting. Their banks were technically insolvent, but functioned day to day thanks to central bank injections. Sound familiar? It's the same storyline with different characters. Europe became Japan with better wine and worse politics. Once again, denial replaced diagnosis. Instead of allowing defaults and restructurings, leaders chose survival at any cost, even if that cost was decades of stagnation. Let's take a closer look at why this global zombification happened. The truth is, financial systems hate pain. Nobody wants to take open losses. Politicians fear losing elections. Bankers fear losing bonuses. And central bankers fear losing control. So rather than facing short-term chaos, they postpone it. They buy time, with public money, with zero interest rates, with creative programs like quantitative easing. Each one promises salvation, but merely injects more life into the undead. The longer it lasts, the harder it becomes to reverse. Now think about what that means for ordinary people like you and me. In a zombie economy, if you have assets, property, stocks, or equities, you look fine on paper because all that liquidity keeps prices inflated. But if you depend on wages or small business income, you're stuck. Your earnings stagnate while living costs creep up quietly. Inequality grows, resentment brews, and trust in institutions erodes. It's not just a story about banks, it's about the fracture of the social contract. When the system works only for the already wealthy, you no longer have capitalism. You have a slow-motion feudalism of money. This global zombification has another dangerous effect. It distorts risk-taking. Investors, unable to earn returns from safe assets, start chasing yield in speculative corners. Cryptocurrencies, tech startups, or whatever the next big thing seems to be. That's why bubbles appear faster now. Capital doesn't flow to efficiency anymore. It flows to hype. And when those new bubbles burst, the response is always the same. More bailouts, lower rates, more denial. It's an infinite loop of artificial revival. The living subsidize the dead. What's chilling about all this is how predictable it's become. Japan's experience should have been a historic warning. Don't delay structural reform, don't protect failure, and don't drown real innovation by keeping lazy giants alive. But instead, that warning became a manual. Politicians around the world now see bailouts as routine tools, not last resort measures. Central banks, once meant to maintain stability, have turned into permanent emergency responders. It's no longer free markets, it's managed survival. Want to see how deep this goes? Take a look at corporations today. Many giant companies survive only because they can refinance debt endlessly at near zero cost. Their earnings don't justify their valuations, but cheap credit keeps them rolling. That's the zombie effect. But this time it's not banks, it's entire corporate sectors. Airlines, property developers, even some global tech firms have become part of the walking dead. They produce little innovation, generate minimal productivity gains, but because they employ thousands, governments will never let them fail. It's a loop Japan would recognize instantly. The most paradoxical part of this global contagion is how normal it feels. In the short term, nobody sees the zombies. Stock markets recover, unemployment drops, and GDP seems stable. But underneath, structural health decays. Economies addicted to intervention lose flexibility. They can't adapt when real disruption hits. Remember what happened during the pandemic? For a moment, the world froze, and governments printed more money in a year than they had in the previous decade. That was the final proof. We've all been living in some version of Japan's slow-motion recovery for years without even realizing it. And yet, there's something profoundly human about our collective reluctance to let things die. Failure feels cruel, especially on a national or global scale. But the longer we protect bad systems, the more fragile we all become. A forest needs small fires to stay healthy. By suppressing those fires, you invite catastrophic burns later. Economies work the same way. Without failure, there can be no renewal. Instead, we keep reviving what should have decayed. That's the essence of the zombie economy. Eternal stagnation masquerading as stability. So, what could the world have done differently? Learn from Japan's mistakes, for one. Accept losses early, restructure aggressively, and never confuse liquidity with solvency. That's economic triage. Painful, but necessary. But most governments prefer the illusion of control. They think they can outsmart the cycle, engineer permanent expansion, and avoid public outrage. The tragic irony? In trying so hard to avoid Japan's fate, they ended up copying it step by step. Some analysts joke that we now live in the lost century, where growth everywhere feels artificially slow despite massive technological progress. It's half true and half terrifying. Because once an economy gets used to free money, it forgets how to function without it. The young people entering today's workforce face the same problem their Japanese counterparts did 30 years ago: low wages, inflated assets, and an uncertain path forward. The names have changed, but the curse remains. Here's the good news. Awareness is spreading. People are starting to question whether debt-fueled stability is really progress. New generations of investors are skeptical of endless bailouts and permanent cheap money. They've seen this movie before. Well, their parents have. And slowly, the conversation is shifting from, how do we save everything, to, what should we finally let fail? That's the only way economies can heal. By facing losses, not hiding them. To wrap this up, understand this. Japan's story isn't just Japan's anymore. It's a mirror showing what happens when societies choose comfort over correction. Zombie banks were just the beginning. Now the infection runs through global markets, corporations, and even politics. We've built a world where survival is mistaken for success and where growth depends on how much intervention you can stomach. But every system has a limit. And when the next reckoning comes, it will test whether the world has learned what Japan tried to teach decades ago, that letting go, not holding on, is sometimes the only way to move forward. In the next chapter, we're going to look at those lessons directly. What Japan did right, what it got horribly wrong, and what every investor and policymaker today should remember. Because if you think zombie economies are a thing of the past, think again. The next wave might already be walking toward us. So, after all this chaos, fear, and decades of stagnation, what did Japan actually teach the world? The answer isn't simple, because Japan's story is not just about economics. It's about psychology, politics, and human. The lost decades were not a single mistake. They were a series of small, logical choices that, when combined, locked an entire nation into paralysis. That's what makes this saga so haunting. Every step seemed reasonable at the time, and yet it all led to 2 lost decades and a deeply changed society. Let's start with the first main lesson. Don't confuse postponement with progress. After the bubble burst in the early 90s, Japan refused to take the painful steps that could have reset its economy. Cleaning up bad banks, allowing bankruptcies, and forcing losses would have been politically impossible but economically essential. Instead, policymakers decided to buy time, to patch holes, and to wait for recovery that never came. Pain delayed is not pain avoided. It's pain multiplied. Whether in Japan or elsewhere, deferring structural reform only feeds the zombie army. The second lesson is about money, or rather, the illusion of it. For decades, Japan drowned its problems in cheap credit and government spending. On the surface, it worked. Stability returned, markets calmed, people kept their jobs. But behind that peace was a dangerous addiction. Easy money is like anesthesia. It numbs the pain but leaves the disease untreated. By the time the numbness wears off, the condition is far worse than before. Japan's liquidity trap, a situation where printing more money no longer stimulates growth, became the cautionary tale central bankers still fear today. Here's something else. Japan's experience shows that confidence is more valuable than currency. Economies run on expectations, the belief that tomorrow will be better than today. Once that belief breaks, no amount of stimulus can fix it. Japan spent years trying to restore faith through interest rate cuts, infrastructure projects, and even negative interest rates later on. But optimism isn't built in bank headquarters. It's built in households. And when families stop trusting in the future, an economy loses its soul long before it loses its wealth. Now let's talk about the role of culture. Japan's social harmony and avoidance of conflict helped it survive without chaos. But those same traits delayed recovery. No one wanted to take responsibility for failure. Not bankers, not bureaucrats, not politicians. Public shame replaced public accountability. In Western economies, failure is seen as the first step toward rebirth. In Japan, it was viewed as dishonor. That difference turned a financial crisis into a generational stagnation. The country chose dignity over disruption, and it paid for that choice in slow motion. There's also a lesson for policymakers around the world. Not all problems can be solved with liquidity. When the system itself is broken, pouring money into it only hides the cracks. It's like painting over rust. The surface shines for a moment, but the metal beneath is crumbling. Japan showed that what economies need most after a crash isn't just cash, but cleansing. You have to let bad ideas, bad banks, and bad debts die. That's how capitalism regenerates. That's how trust returns. Without that cleansing, growth becomes artificial and fragile. Japan's story also challenges our obsession with GDP. For 2 decades, the country's output barely grew, but living standards remained high. People still had universal healthcare, safety, and technology others envied. It proved that wealth isn't everything. Stability and social cohesion have real value. But here's the paradox. Too much emphasis on stability can destroy dynamism. When a society protects comfort above all else, it risks losing the future. That fine balance between safety and ambition is the tightrope every advanced economy must now walk. And then there's the generational cost. The young adults of the 90s became the cautious middle-aged of the 2000s. They learned to distrust risk, to save rather than invest, to prefer predictability over opportunity. That mindset carried into their children, creating a cultural freeze that spread beyond economics. You can't measure that kind of impact on a chart, but you can see it in how people behave, how they fear debt, how they treat entrepreneurship as something dangerous. The lost decades didn't just kill growth, they killed curiosity. Still, not every lesson from Japan is negative. In fact, one of the country's great strengths was its ability to endure without falling apart. While banks in other nations sparked full-blown crises, Japan kept its system intact. There were no mass riots, no political revolutions, no descent into extremism. That's remarkable resilience. It shows that even when economics stagnate, social discipline can prevent collapse. But the price of that endurance was heavy. It came at the cost of innovation, ambition, and collective daring. Japan endured, but it didn't evolve. From a financial perspective, another key takeaway is the danger of mixing fiscal expansion and monetary intervention without reform. Japan kept spending and printing, hoping growth would follow, but the structural blockages in its economy never moved. Zombie companies survived, wages stagnated, and debt piled up. It's like inflating a balloon that's full of holes. No matter how much air you pump in, it goes nowhere. Future governments, including those in the United States and Europe, repeated that mistake, proving that knowledge doesn't always prevent imitation. Here's a more personal point for you, the viewer. Japan's history is not just about governments or banks. It's about people like you who face uncertainty. The Japanese middle class saw the illusion of endless growth vanish, just as many others would during later crises. Their experience teaches a simple but profound truth. Don't let comfort blind you to fragility. Whether it's your job, your investments, or your country, stability is only real when it's built on honesty. Pretending that problems don't exist doesn't protect you. It just makes the fall worse when it comes. So, what if you're an investor watching this today? The biggest takeaway is to understand cycles, not chase trends. Mountains of money can't protect an economy if it refuses to adapt. Governments can stimulate, central banks can print, but innovation, real grassroots growth, only happens when risk-takers are allowed to try and fail. Japan's tragedy was not the bubble, but the long afterlife that came from refusing to bury it. As an investor, remember that sustainability comes from creative destruction, not endless rescue. Another lesson buried in Japan's decades is that technology alone can't save a stagnating economy. Despite its technical brilliance, from robotics to electronics, Japan couldn't overcome its economic inertia because mental and institutional barriers were stronger. The problem wasn't lack of invention, it was lack of reinvention. Systems that preserve yesterday's winners always block tomorrow's leaders. A truly dynamic economy must make space for the new by letting go of the old, even if that means short-term pain. Perhaps the most fascinating part of Japan's experience is how much of it repeated globally. After 2008, when Western economies faced their own crises, Japan's approach suddenly looked prophetic. Massive public debt? Check. Quantitative easing? Check. Zero interest rates for years? Double check. The playbook had gone international, but most countries ignored the morale of Japan's story. Cheap money can buy survival, not rebirth. The difference between those two is everything. Let's not forget, though, that Japan also did some things right. It maintained social safety nets, avoided massive unemployment, and prevented poverty from exploding. It invested in education, infrastructure, and technology, even in hard times. The country proved that decline doesn't have to mean despair, but it also proved that endurance without renewal breeds apathy. A strong foundation is valuable, but at some point, you have to build on top of it again. Otherwise, even the most stable base turns into a cage. In a world that now faces its own new normal, Japan's lessons feel more relevant than ever. Inflation, debt, inequality, tech disruption. These are symptoms of systems struggling between old models and new realities. If policymakers want to avoid another era of global zombification, they must embrace short-term pain for long-term gain. That means allowing unviable firms to fail, supporting creative industries, and focusing on productivity instead of just liquidity. Real reform is scary, but stagnation is scarier. There's a more human angle, too. Japan shows that societies can survive economic winters if they stay united, but unity built on denial can't last forever. True progress requires honesty with ourselves, our institutions, and our future generations. Pretending that we can maintain prosperity through endless debt or artificial stability is like pretending that the undead are still alive. At some point, we must choose between living halfway forever or risking true renewal. One path preserves the body, the other revives the spirit. If you ever travel to Japan today, you'll see a nation that still carries the weight of those decades quietly. People there don't talk about the bubble much anymore. It's become part of the landscape, not just of the cities, but of the collective memory. The gleaming streets of Tokyo and the silent, shuttered small towns tell the same story. Growth isn't guaranteed, and decline can be graceful but costly. It's a living museum of both brilliance and myopia, where the future still glows, but softly, as if through old glass. So, what's the final lesson after all these years? Maybe it's this: economic immortality is a myth. Every cycle must end. Every system must renew itself. Japan showed the world what happens when you try to hold on to the past for too long. The lights stay on, but the energy fades. The polite silence hides the exhaustion underneath. For the next generation, for you, the challenge is to make sure that history rhymes but doesn't repeat. And as you close this story, think about your own economy, your own country, your own habits. Are we building something destined to grow or something destined to survive without evolving? Because in the end, the difference between a healthy system and a zombie one isn't financial. It's moral. It's the courage to face failure, accept change, and start again. That's the real cure Japan never fully took. And maybe, just maybe, that's the lesson the rest of us still have time to learn.